Welcome to the 2025 Economic Preparation and Depression channel. Thank you for joining me on this brief Wednesday, October 15, 2025 edition. Please be sure to subscribe to this channel so you get the latest notifications of when we interpret the financial news as it becomes available. Appreciate your support, ladies and gentlemen. Hope you're having a wonderful Wednesday here. Now, we're going to be talking about tariffs and some other things here about this economy. Tariffs are pushing prices higher and consumers are feeling the hit. As you can see, the tariffs are just getting started here. It's going to take about another 6 months for it to fully take effect in terms of the effects of it. Of course, the 100% tariffs have been threatened with China starts November the 1st. But regardless of the tariffs, President Donald Trump and others, both Democrats and Republicans and others, just regular ordinary Americans know that prices are here higher for longer and going to stay higher for longer, and that companies are going to pass those costs on to consumers, the customers. So the central bank's periodic beige book report categorized overall economic growth as having changed little, according to this report by CNBC, since the last report, September 3rd. Now, remember, we haven't got a lot of data this month because of the shutdowns, I guess, the Bureau of Labor Statistics and stuff, so it may be a little bit delayed before we get the results. But the bottom line is that the tariffs and other things, now this is a trade war between U.S. and China, but the input cost to manufacture stuff over here has gone up tremendously in the last 5 to 8 years, I would say. And also with the Bureau of Labor Statistics, the consumer price index has gone up as well. Now, oil is the only thing that hadn't gone up. As you see, the barrel of oil has kind of gone down here. But the S&P 500 closed a little bit flat today, down about 0.4%. Nothing crazy. It's still above 46,000 in the Dow Jones Industrial. S&P 500 was up only 0.4%. NASDAQ was up 0.66% respectively, and the VIX, the volatility index, was down almost a percentage point. But the 10-year remains elevated above 4% on the Treasury yields. And like I said, crude oil is down at $58.62 here as we head toward late fall in the winter months. But gold is still above $42.24.50, and silver is still above $50 an ounce. So that shows some concern here for others that the dollar may be losing its value here relatively. Because remember, gold and silver is priced in U.S. dollars right now. So the record number shows just how aggressively retail trailers bought the dip on Friday. So they bought the dip on Friday when the markets went down. Many people were buying the dip. We haven't seen a market correction yet, but we will anticipate a market correction next year of 20 to 25%, and it'll only get worse throughout 2027 and 2028 as the market does the correction there. Hopefully it'll be a gradual correction or a soft landing, as the Federal Reserve Bank likes to call it, and not an all-at-once cascade of housing, real estate, commodities, everything up, everything down, except commodities. So Fed Powell said economy may be on firmer footing, but the job market is weak. And that's a bad sign, because he's coming out and telling you, look, there's going to be more layoffs, not just in the public sector. Yes, we're hearing about the government layoffs, but there's going to be private sector layoffs that are going to continue, from Microsoft to HP to the chip makers to all these different companies, as people just don't have this disposable income to sustain these type of things. Even hospitality is not out of the woods yet. Travel and hospitality, as people are not going to be taking these cruises, they're going to be cutting back. Americans are going to be tightening their belt, even though they may have some disposable income from savings, or they're going to be tightening their belt in the midst of a weakening job market. Unemployment, like I told you, unemployment is heading toward 5% here. Official numbers are going to be heading toward 5% by the end of this year, and we expect 6% unemployment by next year, as companies and everybody begin to trim the fat, as the free money, the quantitative easing has not started yet, and that means that they're going to be trimming the fat and cutting down jobs on this market here, and everybody knows it's coming, but we just don't know how that's going to shape, how that's going to fit in with AI and everything that's coming together. And some people are saying they're going to give you a universal basic income, and we know it's going to be digital. We know it's going to be some kind of digital CDBC, but nobody knows exactly how it's all going to fit, because this is a worldwide thing. It's not just in the U.S. It's the European, it's the Asian markets, it's the Australian, it's everywhere. South Africa, India, the BRICS nations. Everybody's feeling a slowdown in growth as stagflation, as these escalating trade tensions with China make rate cuts even more urgent. So they keep focusing. They want you to focus on these interest rate cuts. Remember, there's two ways you can affect the economy: monetary and fiscal policy, and they need to work together. Unfortunately, there's so much money that's been printed the last 5 or 6, 7 years in the economy that's sloshing around, and it only went, of course, to the cream of the crop, the top upper 1%, and the rest of the time we just, besides this $1,000 stimulus checks that some people got, And that really created inflation and just exacerbated the situation, as you know. And so now these tensions, these trade tensions, are ramping up here between China and the U.S., as they say in the news here. This is according to Kitco News here. And so listen, there's going to be elevations, talks, and persuasions. But the bottom line is that everybody knows that the United States and other countries are heading for a slowdown. Maybe not a complete collapse and all of that, but it is a slowdown, and that's going to be labeled. By the time the media labels it recession by the middle of next year, people are going to say, how we got here? We're going to have high unemployment, stagflation. We're just not going to have the growth that we are used to, are accustomed to in this 15 or 20 or $25 trillion economy, or whatever the number is now. We have $38 trillion in debt, right? And we know that this economy is the dollar. People are losing confidence in the dollar. And once the dollar lost confidence because of all these different tariffs and different actions, then that means people are getting into hard assets. You know what that means? Gold, silver. If you do cryptos, that's fine. I'm not saying I have nothing against cryptos. People are just getting out of the dollar any way they can, getting into international markets, leaving the country, or going into real estate, going into any tangible asset that they can find, or commodity that they can find other than dollars, because dollars is clearly losing its value, and it has been. We've told you this on the station many times, and even former chair Alan Greenspan said the same thing. He said, we can print dollars, but we can't guarantee the purchasing power of those dollars, as you know, and we're seeing it. The dollar's lost 97% or 98% of its purchasing power since 1970, since we came off the gold standard. And since we're not going back fully to the gold standard, then that means that currency is going to be dying soon. The dollar, is on borrowed time. It has less than 5 years left of its lifespan. It's done good. It's good for 90 years, but it's now time for it to be retired. The digital currency's coming in, whatever that means, and that means more control for the banks. But that's what we're going to, because the dollar is going to be out of control. So this has been the report for today. Thank you for listening. I'll see you in the next episode. God bless and take care.